Welcome to this market and economic update. In this video, we'll discuss what's been happening beneath the surface of the stock market, specifically how different sectors have been performing and what this means for your portfolio. Many investors are familiar with the broad market indices like the S&P 500 or the Dow, but looking one level deeper at the 11 sectors that make up the whole rest of the S&P 500 can tell us a lot more about what's really driving market performance. Last year, the gap between the best and the worst performing sectors has widened over 40 percentage points. So let's walk through why this is happening and what that means. So let's talk about energy, because honestly, it's been the story of the market this year. We're looking at gains of around 30% year to date, and that's really not a number we can ignore. So what is driving that? Oil. Brent crude oil has been sitting above $100 a barrel, give or take. And a lot of that comes down to what's been unfolding in the Middle East. When geopolitical tensions rise, energy prices tend to follow. And right now, we are feeling that. Here's what I always remind my clients. We've seen this before. Remember back in 2022 when Russia invaded Ukraine? The energy sector finished up that year up nearly 66%. Meanwhile, the broader S&P dropped close to 18% at its worst. So while everyone else was losing sleep over their portfolios, energy was quietly, and maybe not so quietly, delivering. So now oil prices are generally good for energy producers. Their revenues go up, investments flow in, the sector strengthens, and that's the tailwind. But, and this is the part I really want you to sit with, what's good for energy is not always good for the broader economy. When oil prices are elevated, businesses tend to pay more to operate and consumers pay more at the pump. That's a real drag on spending and growth. So, as with most things in investing, there are two sides of the story. And it's our job to understand both. Here's what I really want you to take away from all of this. History is actually pretty reassuring at this point. These supply side shocks, they tend to be temporary. They feel enormous when we're in the middle of them, and you may be feeling it too. But the market always has a way of finding its footing. We saw this play out in 2022, and even after everything that unfolded, the market started to recover relatively quickly by the end of that episode. It always feels different in the moment, but the pattern still holds. Now let's shift gears and talk about technology, because this is a space that I know a lot of you are watching closely. For the past several years, AI has been basically the engine of the market. Those stocks led, and they led convincingly. But lately, their leadership has started to shift. I think that's worth understanding why. Here's the thing. So many of these companies are still posting strong earnings. The fundamentals haven't fallen off a cliff. What's changed is the conversation around them. There are real questions emerging about whether AI tools could actually disrupt traditional software and businesses, the kind that have been reliable and steady performers for the last many, many years. Some people in the industry have started calling the SaaSpocalypse, which is a dramatic name, to be fair, but it captures the anxiety around what happens to software as a service companies in the world where AI starts to do what they do. Now, will those fears prove justified? Honestly, we don't know yet. But what we do know is that the uncertainty alone has been enough to trigger a reassessment of the valuations across the tech sector. And I want to be really clear here. This is not me saying that technology doesn't matter anymore. It absolutely does. What this moment illustrates, though, is that something I come back to my clients with again and again is that market leadership can change faster than any of us expect. And that's really why sitting too heavily in one sector, no matter how exciting or pretty it looks, creates some real risk in your portfolio. Diversification is not just a buzzword. Moments like this are precisely why it exists. And finally, let's talk about where investors have actually been moving their money, because this tells us a lot about the mood of the market right now. As uncertainty has built this year, we've seen a real rotation to what we call defensive sectors. Utilities, consumer staples, healthcare, and honestly, it makes sense. These are areas where cash flows are stable and predictable. People still pay their electric bills, they're still going to buy groceries, they still need their medications, And that consistency is exactly what has become attractive when the broader market feels a little unpredictable. There's also a concept that's been gaining traction lately that I find really interesting. It's called HALO, heavy assets, low obsolescence. And what that means essentially is that companies that are built around physical assets and manufacturing, the kind of businesses that aren't easily disrupted by the next wave of technology. In a market that's been rattled by AI uncertainty, there's a growing appreciation for things that are just harder to replace. Now, take a look at this chart for a moment, because this is something I genuinely want you to internalize. Sector leadership rotates constantly. The top performer this year can easily be the laggard next year. And that's not speculation. That is history, folks. It's the single best argument I can make for why broad diversification across sectors is not optional. It is essential. I really hope that this is giving you some useful context for what's been driving markets and where things stand and where they're heading forward. If any of this has really sparked questions about your own portfolio or how you're positioned, where your exposure sits, whether your sector mix still reflects your goals, please reach out. That conversation is exactly what we're here for, and I'd love to connect with you.